So what I did was I was really curious to kind of crunch the numbers on something like that and take a look and see what exactly is the impact um, to your home total home ownership, to how much money you're going to wind up paying, to and based on a couple of different scenarios. So the first one I took a look at was a $600,000 purchase. Is that larger? Can you see that now?
That's
Okay. So I looked at a $600,000 purchase, and I'm assuming that someone with a $600,000 is going to buy a $600,000 home is going to put 20% down. That's just an assumption. I did another scenario that I'll show you guys in a minute, and that one was for a condo for $400,000 with less money down. But I'm just assuming $600,000, 20% down. Right now, I'm sure Patty would agree with me. You're getting a rate somewhere around 3%, in that vicinity, give or take, depending on your credit scores. But I just wanted to use round numbers so it'd be a little bit easier to remember these figures by. So what I did was I came up with this scenario and I said, well, if it's $600,000, you're taking out a loan for $480,000, your rate is $300, your total monthly payment, including taxes and insurance, would be $2,723. If down the road, a year down the road, 2 years down the road, prices did go down, hypothetically speaking, and I said, let's look at a 10% price drop versus a 1% increase in interest rates, right? So now, assuming there was a 10% price drop and you had a $540,000 home, same home, dropped 10%, okay? Now you're at $540,000 for a purchase price. You're putting the same $20,000 down. So yes, you are coming out of pocket with a significantly less amount of money, okay? Almost $13,000 less because of the drop in price. But your interest rate is now 4%. So your total monthly savings on a monthly basis is a whopping $31.20, 27 cents. Not a big difference for owning, for waiting a year, waiting 2 years. But the chances of it dropping 10% are, who knows? I mean, I wish I had a crystal ball to tell you exactly where prices are going to head, but interest rates don't have much lower to go. I can tell you that much. There's just not enough margin in these rates for banks to be profitable, to be able to lend money. At some point, they're just going to stop lending because they're not going to make money on these loans anymore. So what's the point in them giving out the loans? People aren't going to be able to buy houses because they're not going to be able to get the loans. So that being said, I said, what if we go to 4%? What's the difference? Okay, $31 a month. Over 5 years, though, look at this. It's more expensive to have owned that home with a higher interest rate, but a lower price. So let's take a look at that for a second, right? So your monthly payment is a whopping $31.20 difference. Over 5 years, though, did you have a question? Over 5 years, though, you're going to wind up saving yourself $14,000, over $14,000, by buying a more expensive home with a lower interest rate. And the reason being is because your interest costs are so significantly different. Not only that, but in the long run, you're also going to be paying down more principal. So what does that mean, right? What is a mortgage comprised of? Principal and interest payments, right? So your principal payments, I always try to tell my clients to think about it like a forced savings account, all right? Every month, you're forcing yourself to save a little bit of that money, okay? And in this scenario, when we look at it, the more expensive home, you're forcing yourself to save, principal and interest payments here are $21.23, here they're $20.26. My breakdown is for principal payments. Where'd it go? It's in here somewhere. I'll find it. Here we go. So principal over the 5 years, I would have paid $53,000 down from the loan that I took out. So if I was to sell that home in 5 years, I would have $53,000 basically saved up, assuming that all in all, what I did was I put a 3% appreciation for the home on an annual basis, which is pretty conservative, right? So you would have $53,000 stashed away just in the money that you've paid back. So assuming you sell it for the same dollar amount, you would have gotten back that $53,000, okay? However, if you were to purchase a home weighted, all right, and you were to purchase a home for $540,000 with a higher rate, you've now only saved $41,000 in that same 5 years. So you're talking $12,000 right there just in principal that you've paid down to the bank. Not only that, but look at the difference in interest that you've paid. You've paid almost $14,000. Actually, the number's right here. $14,000 more in interest over the same 5-year period just by waiting. You cost yourself more money by waiting and taking a higher rate at a lower price. That's a 10% price drop. That's a big drop. So to me, that doesn't necessarily make sense. This is exacerbated and honestly, it compounds on itself when you look at what the interest is that you've paid over 15 years. Because if you buy something at 4%, the chances of it coming back to the threes are slim to none. Like more than likely, we're not going to go through what we're going through again in our lifetimes. This is a once-in-a-lifetime event where we're getting these rates at historically low rates. They might last for a little while, 6 months, 12 months, but the prices go in conjunction with these. So when you look at it over 15 years, you would have spent an additional $40,000 in interest. $40,000 for what? Just for borrowing that money. You're still owning the same home. It's not like the home has changed, right? So when you change the parameters, right, and you go and take a look at the analysis on it, and say you want to take a look at the total principal you paid, so not only did you spend an additional $40,000 in interest, right, but the principal that you've paid, where'd it go? The principal that you've paid between those two, you would have paid down an additional $33,000. It's not switching over. I'm sorry about that. Does that make sense though?
Well, I see the numbers every single day, and I look back and I look the old CDs and the HUDs, so I can see what a difference it is between, the same loan amount with a higher interest and how much money they're saving. And I keep telling people every single day, that's why you can afford a little bit higher price right now, because you're still going to be paying less at the end. So I don't remember seeing rates this low.
Ever. Ever. And so I did a similar analysis for a condo. And so when you take a look at a condominium, even if it drops 10%, we're at 3% compared to 4%. I mean, there's a whopping difference of $33 a month from a monthly payment standpoint. But then take a look at how much principal you're paying every month. You're forcing yourself to save an additional $140, $150 just by taking a lower rate and buying a more expensive property. But the payments are almost identical. And again, when you look at it over a period of time, this takes out net payments. And basically the software that I use kind of gives you the tax benefit of owning, and it subtracts the tax benefit and the principal paid, because it's assuming at some point in the future you're going to get that money back when you sell the home. So it's kind of like I mentioned earlier, a forced savings account. So that's where these net payments are coming from. So I'm comparing a $400,000 purchase to $2,000 in rent, right? No matter what, we all get that standard deduction, which is going to come out to about $480 a month, given like a 24% tax rate. So from a net monthly standpoint, if you're renting, your equivalent rent is about $1,520 after tax. But here, you're owning for less than what you're paying for a rent for a $400,000 condo. And this is, I just did with 10% down. And so when you take a look at the principal that you pay in 5 years, you would have literally pissed away almost $30,000 if you kept renting for 5 years. But here you would have saved yourself in principal $40,000 in comparison to, you know, if you waited a year and interest rates did go up, or I don't know how long, excuse me, I shouldn't say a year, but if you waited long enough where prices did come down, but interest rates did go up, you would have wound up, you know, in 5 years, would have spent, you know, you would have saved $9,000 less. You would have spent that much more on a lower payment. And then when you look at the principal, I mean, it's extraordinary. You know, in 15 years, if you would have rented, you would have spent almost $500,000 in rent. You know, at the same time that you would have paid down $140,000 on a loan if you bought right now with these types of rates. Versus waiting until it went down an additional 10%. So I mean, when I did these numbers, I looked at it and it was a wake up call. And I've got this entire spreadsheet, this breakdown that I can share. It's a simple link. I can share with you the link. And anybody can go in there and take a look at it. As a matter of fact, what I'll do is I'll go over and make sure that I share it in the chat, so somebody can jump in and grab it whenever they want. But it's mind-boggling when you take a look at it from a grand scheme of things.
Well, I think it's also interesting when someone tells me they want to wait like 6 months or a year, how much are they spending in rent while they're waiting just for that 6 months or a year, and then add that to the interest rate that they may be getting. I mean, because we don't know, but the chances are this interest rate won't last. If the economy picks up, then it's going to be the interest rates will probably go up too.
Oh, absolutely.
So then they're going to wait for what exactly? I'm not sure. For somebody to tell them it's okay. I'm not sure. You know how that is. So, you know, then meanwhile, they're paying rent. Most of them are anyway. And that the chance that they have to do this now goes and passes them by. So they end up paying more interest probably. I mean, 4% is still considered quite reasonable, but the difference that 3% makes, it's just mind-boggling. And I know that the people who are getting government-backed loans are going to even save more right now. What kind of rates do you have for FHA and VA right now?
I mean, I'd say they're in the mid twos, mid to high twos sometimes. You can buy it down into the low twos if it makes sense. But yeah, usually around the mid twos I'm seeing.
That's amazing too. I mean, that's mind-boggling. When you look at that kind of money, it's almost like, you know, give it to you for free.
Yeah. I keep telling my clients, if you can lock in a rate that starts with a 2, you're golden for life. Like you'll never get rid of that mortgage.
Yeah, you're set. You know, you're just set. So, speaking of that, you know, you were mentioning that you were going to go over some of the new regulations for FICO scores and qualifying, because they seem to have improved in the last couple of weeks.
Yeah, you know, and each bank is a little bit different. So I work for Movement Mortgage. We're a direct lender, privately held direct lender. Bank of America is the 6th largest purchase lender in the country. And you know, we put in overlays as well, which we are always the first people to say that we follow Fannie Mae and Freddie Mac guidelines to a T, but there was just so much risk in the market between March and like the end of June that we really needed to weed through to see how bad everything was going to happen. And what overlays are basically rules that lenders will put into place to, to mitigate their risk. And so we put in our own, and we raised our credit scores, qualifying credit scores, to make sure that we weren't exposing ourselves too much during this time, because there were a lot of people, and unfortunately there still are, and I've got a feeling there's going to be even more down the road, people that have, requested forbearances. It's just basically a break on your monthly payments. There have been people, millions of people out of work. I mean, I think we're up over 10% now is what the number is, but I'm sure it's a lot more than that when you take into account the amount of people that are working the same full-time jobs that they were prior to this, global pandemic. So at this point, we started to see an improvement in the market. So we did lower our credit scores for government loans back down to 580 for a manual underwritten loan for VA and FHA. You still have to have compensating factors. You still have to have good credit. You still have to be making your payments on time. You might have had some dings in the past that have caused your credit scores to go down, but the automated systems still have to like you in order to be able to get an approval through in order for us to be able to do that loan. So it doesn't just because you have that credit score doesn't mean that you're still going to qualify. You still have to have the debt to income levels to qualify. You still have to have the assets to qualify. So
what kind of number are we looking at then for debt to income ratios in movement?
It really depends on the type of loan that we're talking about. A lot of these big banks, especially jumbo loans, for instance, let's talk about those for a second. They just almost completely went away for a little while. It was virtually impossible to get a bank to lend you anything over a conforming loan limit. Up to in San Diego, it's 701-500. So it was very, very difficult. We're starting to get our big banks back that we've always been dealing with, and some of our investors are like the Chases and the Goldman Sachs and the Citibanks of the world, but they're finally coming back. Those debt to income levels got brought down. They were probably about 43%, 40 to 43%. Debt to income levels on conforming loans. We saw them like upwards of, you could push 49.99. Okay, on a conventional loan. They started making adjustments to it. We're down, some of these loans I can't get approved for more than 45% now. They just won't go through the system. I'm literally 45.1, no. 49.9, 44.9, I get an approval. So it really, every single person is so unique. They're like a fingerprint between their credit scores, between how much money they have in reserves, between their payment histories. Fannie Mae actually looks at payment histories now. They don't just look at, your credit score as a blank score. They will see that you're making marginal payments on your credit cards and not paying it down. And their AI, their algorithms behind all this, they take that into account now. They give it some weight. So, when all this happened, they did reduce those numbers. Like I said, it was about 45% was the maximum I was getting approved at. Sometimes I could push it to 47 if they had reserves, if they had good credit, and so forth. So, you'll see that come back. But with government loans, you can push it a little bit higher. VA loans, I've seen upwards of 60%. Sometimes it can even go a little bit higher into 60%. But again, once you get into that category of debt to income levels, there are additional guidelines that we have to follow with their income and having residual income for VA loans. For instance, FHA typically caps out at 55%, but more recently, I've seen it being pushed down below 50%. So it really, really, really all depends on the individual. Everyone is so unique, and you know, it's everybody's financial picture is like a fingerprint. You know, they're all one of a kind. So
Yeah, that's so interesting to hear the differences that's going on. So the trend is to be a little bit more lenient, but yet still strict.
exactly. One of the other things that we've seen that's been a huge impact on our borrowers are the new guidelines for self-employed borrowers, for instance, because there are so many self-employed people out there that have been so hard hit by what's going on, you know, with all these rules and regulations about closing stores and not letting people in, and how much money they're making if they're even allowed to open and function and so forth. So you know, Fannie Mae did put out some new guidelines where we're required to now request a year-to-date profit loss statement. They have to be audited profit loss statements. And then if they're not audited, we need to have bank accounts for the company showing that the year-to-date profit loss that they've provided us matches up with the income that's actually flowing through their accounts.
Hmm.
We never, ever used to have to do that. I have literally had someone write on a napkin what their profit and loss statement is and submit it, and it was fine. Like, it didn't matter. We just took their word on it, basically, for a self-employed borrower, because typically we're looking at their tax returns. We're looking at what they've claimed for the past few years. But this year is very different because of what we're in the midst of.
And I'm just going to say it's the exact same thing with us. That exact same thing in our calls today.
Yeah.
Yeah.
So it's you know, it's across the board. I mean, it doesn't matter what bank you're working for. We're all following the same guidelines, not to a T necessarily. Some banks are a little bit more conservative than others. Some are a little bit more liberal, but in the grand scheme of things, the big banks especially have put on so many overlays. They've put on so many of their own rules right now because they're so scared of lending money to someone that who knows if this little mom and pop shop is going to exist in the next 6 months. Who knows if this bartender or waitress or, you know, Uber driver is going to be able to make any money, you know, in the next 12 months. So they have really, really, really pulled back on the reins as far as lending is concerned. You know, but smaller direct lenders, they're a little bit more liberal when it comes to these kind of rules and regulations. So it makes it a little bit easier to work with us than it does with huge banks.
But aren't they still selling to Fannie Mae and Freddie Mac?
Not necessarily. Some of them portfolio their own loans. Some of them service their own loans. You know, some of them aren't going to go through a Fannie or Freddie. The big banks, they don't need to. They've got their own money to lend out. And they'll sit there and they'll service their own money. So,
You find the credit unions are stricter
yeah, credit unions
across the board.
but again, they've got their own rules because they don't play by Fannie and Freddie rules. They don't care. Like,
Yeah.
they will set up whatever they want to do. If they don't want to charge you for closing costs, they don't have to charge you for closing costs. They don't have to, you know, create a lender credit to cover it. They just won't charge you. They do their own thing. So everyone's a little bit different. But again, this industry, the mortgage industry as a whole, is so inundated right now with refinances. I mean, the whole industry flipped on its head. So it used to be a third refinances, maybe a quarter to a third. And then the majority of it has been purchases for as long as I've been in the industry, at least. And now it's flip-flop. So now it's like 2/3 to 3/4 refis. And it's just, it has put a tremendous pressure on just the throughput that we can handle, that any bank can handle right now. And so you're seeing these big banks, these credit unions, a lot of them are throwing up their hands and they're just like, I can't take any more loans. I just can't do it. Like, just stop.
They're not processing. And I had a fair share of big lenders actually, you know, just struggling to do the processing of those loans because the amount of refis that they have, or sales that they have, they are not coming up on time. And I can tell that those people that are processing those loans, they are not really people that have experience on this industry. They're probably recently hired. they have no clue what they're doing, you
Yeah.
know. So
everywhere.
just
It's everywhere.
keep in mind.
You know, we're not exempt from that either. You know, we're beyond capacity. I mean, it's taking us 45 days to close a refinance, but at the same token, I could slam a purchase through in less than 3 weeks. And again, we're purchase centric, so those always go to the top. We've got deadlines to hit.
I'm talking about purchase. I can totally see, you know, holding up the refis. Like you said, you know, the majority of the deals right now are refis, but on purchase, you know, just
Well,
off.
Claudia, I know you got my cell phone number. So when you get stuck, you know who to call. I mean, I don't know what you're doing.
Oh, believe me, some of those out there, and I'm like, oh boy.
So I mean, it unfortunately it's happening out there, and there are like the big corporations. They don't care. They're just like next.
Mm-hmm.
They don't prioritize. You know, I mean, I got into escrow today, 21-day escrow. They want to close by the end of the month, and I'm like, okay. I got in touch with my disclosure specialist. Those things are out within an hour. You know, we'll be able to order the appraisal this evening. So, I mean, granted, the order probably won't be placed and nobody will get in touch with anybody until Monday, but we can make things happen. You know, smaller institutions are a lot more agile than that. But it's still, it's tough out there right now, especially in our industry. And I'm sure escrow's seeing the same thing.
Oh, absolutely. Absolutely. You know, I get agents calling me all the time, and sometimes Linda, it's going to make you save $5 a month because we know what the numbers look like in the long run, you know. And I'm like, imagine yourself with a moving truck in the middle of COVID situation, and you can't close because you plan ahead of time because you're trying to save $5.
Yeah.
That's not the point of this, you know. This should be your home. So it's unfortunately, I mean, we know we work in this industry, so we know what's going on, but, you know, the buyers out there or the clients out there, you know, and that goes for the agents dealing with sellers as well, you know, to make sure who's the lender, is it, you know, I don't see a whole lot of buyers not qualifying. I just see big banks. I'm not going to put any names out there, but just struggling to process the loans on time. And when they are processing the loans, they're struggling at the very last minute with underwriter conditions for items that we see happening before, but someone overlooked, and it gets a little hiccup at the end, you know. So yeah, that's what I've been seeing. With those rates, you know, that's what we're going to see.
Rob, industry average, I have no idea. I can tell you that
It's not out there.
there's no such thing as an industry average. You know, I know most big banks are taking 45, 60 days right now. They can't move faster than that. I have heard a couple of really good success stories with some big banks going 30 days. But for the most part, they're a little bit slower than the smaller institutions. We're still cranking away 2 weeks. 3 weeks. Sorry, 2 weeks is going to be hard right now. It's going to be really hard. You literally have to have all hands on deck and be willing to take the brunt end of the stick from everybody for putting in a 2 week escrow. So, but yeah, I mean, 3 weeks to a month isn't a problem for us.
I know that.
So I heard something about the FICO scores being lowered for VA people, that they didn't have to come up to. But what is the FICO score limit?
Yeah, VA and FHA got lowered back to 580. So they got
580. Oh my
yeah,
God.
they got pushed up to 620 for a while to kind of match up with conventionals, but we've just recently, within the past month, have lowered them back down to 580.
Wow. So if it's VA, if it's FHA, is it the same or?
Same.
But for conventional, it's
620.
What?
620.
620.
Mm-hmm.
So that's lower than it was before. Everything was like 640 before.
Conventional has been 620 for a long, long time.
Okay. Yeah. So, well, that's
So,
good.
but yeah, things are definitely loosening up a little bit, which is good. Who knows what's going to happen a couple of months down the road?
Yeah, so it doesn't look like this COVID thing is going to clear up very soon without a vaccine.
No.
So we're kind of stuck in this environment. How is this play for you guys as far as your business goes? What is the difference between now and before COVID as far as your business goes?
I mean, I've never been busier in my life.
Well, you've got all those refis beside everything else.
It's wild.
Mhm.
It's yeah, and I have a little 9-month-old that can hear in the other room, and they're trying to find that work-life balance right now has been kind of hard, because everybody and their mothers and brothers and plumbers and daughters are trying to refinance, and you're just trying to help everybody out because this is a once-in-a-lifetime event. My eyes, at least, you know. I just want to be able to help and give back as much as I can to as many people as I can help. Right now, at least.
Do you still have to have 2 years of tax returns to refi?
No, not necessarily. For a self-employed borrower, you do. But a
For
W,
self-employed, you do.
yeah. But for a W-2 employee, we're down 1 year of W-2 sometimes. It really depends on their work history, and what the automated system spit out. So, we put in an application into the automated underwriting systems, and they tell us what kind of documentation we need. So if we need 2 years, it'll tell us go get 2 years. If we have automated verifications of employment, I mean, they put a little bit of a pause on the day one certainty, but a lot of times they weren't even requiring W-2s and pay stubs because we had a verification of employment from Equifax, for instance, where we know exactly how much they're making over a period of time, and we didn't even need pay stubs. So it really depends on what the systems say that we need.
If somebody's on forbearance, can they pay back what they owe and then refi, or do they have to wait a certain amount of months, or what do they have to do?
No, as long as they're current on their loan.
So as soon as they pay back their forbearance,
Mhm.
it won't jeopardize their qualification.
No, I mean, they can't have like a 30-day late.
No,
Once you actually get hit with a 30-day
but
late,
forbearance is not a late, right?
um, it shouldn't be. But
Huh?
it shouldn't be, no. But again, there are some people that just, they don't understand, and they don't follow. Like it happened to me recently where I had a gentleman who was like days away from getting a 30-day late, because he was under the impression that because he was in forbearance, he could keep going with this. And he was literally, we're at the end of June, and I'm like, yours says like you're done by the end of June. You need to, excuse me, it was done in June. Like, you need to make your June payment. If you don't make your June payment and it's like June 28th, I'm like, you're not buying a house, you're not refinancing for 12 months. Like, because we have to follow standard, credit event guidelines. If they do have a 30-day late, it's waiting 12 months to be able to do anything. So as long as they follow the letter of that forbearance, they catch up, they're current, we can move forward.
Wow. So that's good for people to know. I mean, the forbearance can be extended. They just have to go through that.
Correct.
So if they just don't pay attention and their forbearance ran out, and then they were thinking it didn't run out or something like that.
Rob, I'm trying to read your question. What's the industry average for purchases? What's your standard for months of employment?
Yeah, somebody's just started a job, not too long ago. How many months of employment you need to see consecutive,
It's again a very unique situation. For instance, I've got a professor that's been in school getting his thesis, and now he just started working for UCSD. Okay, as soon as he gets his first paycheck, I can fund that loan, because I can count his education as experience. So it really depends. Like it's not like a matter of whether or not you have work, but you could have switched jobs, and as long as you have been working in the same field and you didn't go from being like, you know, an electrician to, you know, I don't know, an Uber driver. I don't know. I'm just trying to make things up. You know, as long as you didn't switch industries completely, then you can keep going, and we can use previous work history as a 2-year history.
And I believe like you're not relocating because you can be on the same industry, but if you're relocating to a new place, like for us, you know, like for Ashka, for example, same thing I used to do in LA, but coming down here because it's a new location, that does make a difference, right?
You might be considered sales. A lot of salespeople, they'll kind of put those restrictions on there because they're assuming that you need to build up your business again.
Yeah.
If you're going into a whole new territory, and you need to show that you can generate the same type of income that you did before. You know, so like a real estate agent, if they move from here to Oregon, I don't know, and they were, you know, you don't know anybody up there, how are you going to make the same money that you've been doing here for 5-10 years, right? So yes, that could occur, but in certain industries it doesn't matter. You know, if you've been working as, I don't know, a consultant, and you're a W-2 employee, and you move from New York to LA, you know, just working for a different firm, but you've got a W-2 job again, you still have continuity in your employment. You can still keep going and purchase a home. So again, every situation is so unique. It's so hard to like answer a question like that and just give you a straightforward answer because everybody's going to be a little bit different. Does that make sense?
Yep.
Well, this is awesome, Ed. I appreciate the link. Somebody else might have a question. Patty, you know, she does loans in Oklahoma, but she also has a California license. And if it weren't for COVID, she'd probably be out here a lot more often.
Yeah.
So do you have any questions for Ed or any comments?
No, but I just have to say it is the same. It got worse. It's gotten a little bit better, but it's really hard to answer some of the questions because it depends on score, income, job, and like you say, it isn't always 2 years of a job because the education, you know, if you went to school for a welder though and got a job as a waiter, it may not count, but your PhD is going to count. So,
right.
Yeah. And it has just been crazy with the loans, the refis right now.
Yep.
Julia, this is your first time on the call. Did you have any comments or questions you'd like to make? Anything that you found interesting? I think you're mute.
Can you unmute her?
Got it. I do have one question. We have a second home in Coachella Valley.
Nice.
And our current rate is, I believe, like 3 1/8. For a second home to refinance to a 2 point something, is that possible?
Possible? Is it worth it?
Well, I guess
that really depends on what, you know, I would have to ask you a whole bunch of questions to figure that one out.
Okay.
You know, how long are you going to keep the home for?
We plan to keep it. And we actually want to pay it off as soon as possible. So we would love like a 15-year loan. So it would be awesome if we can get a 2 point something and 15-year loan.
15 is definitely possible, you know, but then it boils down to, are you comfortable with with higher payments, right? If you have a 30-year loan and you cut the term in half, depending on what your balance is, those payments would go up. And are you comfortable with that? So that's really a matter of, you know, diving into the numbers and having that discussion. And this mortgage coach software that I used at the very beginning to show you those numbers, that's what I use with all my clients to really do the analysis and make sure that the numbers work. right?
Okay,
And it's all it boils down to is numbers. And if you're comfortable
Right.
with them, then yeah, do it. And if you're not, then
Well, Ed, you should
Right.
put your contact information on the chat.
yeah,
And where can get hold of you, Ed?
That's what I mean.
So
So,
that's
what,
my personal cell phone
Julia,
number
it
for you.
sounds like to me, though, my question would be, if it's a second home, is it a non-owner occupied rental? Or what is it? You know, because if it is non-owner occupied, then it might be a situation where it could get a lower interest rate.
Yeah, I mean, again, everybody's a little bit different. So, you know, those are questions that we would have to ask after we get an application and kind of dive a little deeper into their particular situation.
Okay.
It's kind of like
Thank
asking
you.
a doctor for a prescription, right, without getting a diagnosis first. So,
Yeah. I was just curious if, you know, if it's the second home and how that works for the interest rate.
second home are pretty much the same rates as primary homes. Investment properties are a little bit more expensive. So we'll just have to take a look at what the use of the property is and figure that out.
Thank you.
Yeah, absolutely. Feel free to call me though if you have any other.
Okay, sure. Okay, thank you.
Yeah, you bet.
Well, I'll be sending everybody the call, the Zoom call, everybody who's on it. I send it out to you guys. So, you know, Ed, you can use it for any promo that you would like to use it for.
Cool. Thank you, Judy.
And if anybody wants to share it with a friend or, you know, anybody, then they can share it, and they can also go on my website and see all the past calls, because I archive them. I keep them there as part of my website. So it's very nice to have that. I'm working on putting them on YouTube, and I have some challenges with that, but I was able to do one. Maybe I can do a couple more and put this one on YouTube.
Cool.
So that's always nice as well, to have that availability to promote it. And you know, I'm always looking for more guests, more people to participate. I'm so happy that Julia, that you made it on the call, because I talked to you about it a couple of times.
Yes, thank you.
Really appreciate you being here. And Rob, it's nice to see you back as well. I had a couple people
Well,
that
thank you.
couldn't make it today, but I know they'll be back another week. My team members are busy out there selling properties. I don't know what they're doing. They're making money. So that's good. Yeah, Andy had to show property today, and Iris is deep into her refinance and qualifying and everything. Claudia, it's always good to see you as well. And Patty, thank you so much. And how about a big applause for Ed? And any last things that you'd like to leave us with, Ed?
No, you know, it's an extraordinary time right now, and I think the more people that understand that and take advantage of it, they're only going to benefit in the long run.
Yeah, I think it's like an amazing opportunity.
It really is.
And I convey that to people every day as well as I can. But it's so hard to get through their heads what the media is preaching about, how it's dangerous and it's this and it's that, and you should wait because everything's so unsure. And I'm going like, here's somebody giving you this incredible gift of low interest rate for 30 years fixed, and you can't do it because what? Now, if people have lost their job, I understand. There's no getting around that. But if somebody's in a solid job, I mean, those numbers, they don't lie. What you showed, for the price to go down for 10%, you know, the only way that's going to happen is if it was overpriced to begin with.
Yep.
Or if it was a complete disaster.
But that's where awesome real estate agents like yourselves come in with the negotiation power, right? You go in there and you like do your ninja magic and you get that 10% off.
So what do you think? You think that the prices are going to go down, or we're going to get more inventory? That would be nice. more inventory is good.
Yeah. The
But-
demand is out there, for sure.
Where is it gonna come from?
Joanne, no.
All right,
You know,
well, thanks a lot, Judy. I really appreciate you inviting me.
Oh, my pleasure. Thank you. So, well, I'd like to wish you, thank you for everybody that came, and let's do it again next week. I'm not sure who our guest will be, but we're gonna find a fabulous guest. They have all been wonderful. And Ed, you were great today. Thank you so, so much.
Thanks a lot, Judy.
Pleasure having you here. So thank you, everybody. Have a
everybody.
great weekend, and thanks
Bye.
for coming.
Thank
Take
you.
care.
Bye.
Bye.
Bingo.
Thanks, Judy. Bye-bye.
Bye-bye.